Welcome to Fantastic Females, our adventure to finding the mythical island of freedom together. I'm Kalyani.
And I'm Rupali. We are your next door finance experts sharing our experiences in the world of money and energetics.
Welcome to episode 17 of Fantastic Females. Today we'll be talking about 2022 as a year. It's been a very complex year in many ways, and we want to go into more detail.
Yeah, so I think it's been a really interesting year, right? There's been so much happening. Everything has been either at an historic high or a low this year. That's all you see in the press, historic, and then at some point you get over it because it's no longer a big deal, because that's what human nature is, right?
Yes. For some context, the US economy is represented often by the index S&P 500, which is down 19% this year. And the Dow Jones, which is more of a collection of industrial stocks, is down 9%. Nasdaq, meanwhile, which represents the tech industry, is down 31%. And this really shows where the gap in the market has been in this year. And the downward spiral has been led by technology and growth companies majorly, while oil has only been down 1.2%. One interesting thing that we've noted is bonds are down by 10% as well. And I was having a discussion with Rupali about how that's possible while stocks have been going down. Normally, there's a reverse correlation, and we'll go into more details to understand all of this. Any comments about all the negative numbers, Rupali?
Yes, it's been quite a full year. I think what my first takeaway from the fact that it's been all negative is it could be cheap to enter today, which is the take I take on it. Where you invest is more important today than ever before, because like Kalyani said, correlations between stocks and bonds are typically negative. They've become positive this year, which means bonds and equity markets have sold off. Obviously, bonds have not sold off as much. When I say sell off, I mean dropped in value or negative returns. Basically, people have lost money if you count your valuation from 1st January until today. And with bonds being down 10-11% versus equities of 19-20%, which is the S&P, it's still half of that, but it's all still in the same direction. And this year, like I said, there's been so many historic things that have taken place with inflation. We've had this discussion on interest rates, the drivers, which we'll keep going into as and when it comes up. But what's happened this year is there's been so much uncertainty around inflation. There's been a lot of uncertainty around what the Fed will do in terms of controlling inflation, because that's their mandate, right? Unemployment and inflation is their mandate. And so they have to be mindful of that. And people speculating on what the Fed will do in terms of interest rates has caused markets to sell off even more, because there's more risk that people perceive than may actually be prevalent in the markets.
Yeah, so let's unpack this interest rate situation a little more. So from what I remember, when 2022 started, they had already stipulated that they might do up to 9 rate hikes. And I don't remember that the percentage was discussed back then. But what's happened in effect is they've had 7 rounds of rate hikes, taking the interest rates from 0.25% at the beginning of the year to 4.5% after the last revision, which was mid-December. And every time that this has happened, it's a bit of a cycle when the Fed has a meeting, then they have a press conference, and then, it's in effect. And every time this cycle happens, there's a big reaction in the market in terms of a lot of fear coming in, and there's generally a sell-off. That then is fueled by the inflation reports for the month, and these have been going up steadily, especially till June, where we saw the inflation numbers peaking at 9.1%, and since then they've been slowly but steadily falling. But that's a weird correlation as well, right? In terms of seeing inflation at such high levels while we were seeing such a blunt increase in interest rates.
Yeah, what's caused this inflation uncertainty is the fact that COVID happened. The Fed stepped in to help the economy in terms of not completely suffering, and so they made money cheap, as we discussed previously. If you'd like more color on this, then please listen to our previous episodes. And as a result of that, they were quite aggressive in making money cheap, but they were not aggressive enough in bringing it back to balance. And so they've overshot in terms of interest rates today to try and catch up for it. The Fed was, being mocked as being late, as being too slow, and so part of that is now being undone by more aggressive interest rate hikes, which means there's less money in the circuit and in supply, and so people are more conscious of where they spend. I mean, a simple example is, rates have increased by about 4.5% this year, and which, means if you've got a loan that is 1 million dirhams, then your interest payment has increased on 1 million dirham loan by about 750 dirhams a month or 9,000 a year, which is quite significant because it does impact your lifestyle. It impacts the way you think of your money. It impacts the way you plan and budget. And so this was a very deliberate thing that was done by the Fed, the US Fed, to control inflation, to make sure that things don't get overly expensive, to make sure that things don't stay expensive. And
I suppose we don't want to go into a place of stagflation, which we've also discussed before, where things carry on becoming more expensive and eventually businesses are not able to hire employees because their costs of running the business are so high that they can't hire extra people for the extra jobs. Then that puts the economy in a weird funk of having high inflation and high unemployment rates, which is then very difficult to reverse. So this has been their blunt solution, and we've spoken about this in detail in our previous episodes. But the consequence of that is that the market is full of fear and anxiety. But one other thing that we've also mentioned before is the emotions of the market, and the fact that the markets are generally the first place to see an impact from an economic move, whether it's negative or positive. So a lot of our belief, talking for myself, and Rupali can then elaborate on it, is that this anxiety has played out in 2022 so much that it's probably already priced in a so-called recession, which is being spoken about a lot. Which means that the effects of a possible recession have already shown in the market. So if you look historically at some charts, I was looking at an interesting chart where it showed that when the inflation has peaked and the GDPs have bottomed, which is the perfect point of recession, in terms of data, just after that, a sharp recovery phase starts. And if they put this in relation to S&P 500, S&P 500 has shown to be decreasing a lot more before this bottom has been reached. The bottom of the recession is reached actually on the graph. And then, the recovery kind of follows. So that shows that despite the fact that a formal recession may not have actually come about, the market has already taken it into account, has already reacted to it, which means that then it's only a matter of getting better and recovery from then on, if that makes sense.
Yeah, I agree. I think because it's already priced in, which means it's already sold off quite a bit in anticipation of the economy suffering, in anticipation of a recession. It means that there's on the down leg, there's not much remaining. You can't time the bottom like you can't time the top. And so it's less likely to go much further lower than it would be to go up, is the conclusion that I take from this. And what investors do is look at markets and gauge what the sentiment is out there. So it comes back to emotions, as what Kalyani mentioned. and these markets actually guide you into letting you know what the sentiment is out there. And this is why a horrible situation can happen where markets have already sold off, and that sets further panic in the market because people think, oh no, there's a big thing that's on its way, and more people sell, which makes it worse, and more people sell, and until people now collectively think that it's cheap, and then people start buying slowly, which is where technical trading comes in, which is where you can see the signs or these technical indicators, which Kalyani is an expert in.
Yes, that's exactly what I look at on an everyday basis, and I teach from my business called Trading Mom in the course called Investing Starter Course. Technical analysis has been a little hard to read this year as well because the bottoms are bottoms, but then there's another bottom which is lower, and we've gone through a few cycles of what Rupali just mentioned in terms of having fear and then a sell-off and then a further sell-off. But what's encouraging to see is that things are turning around, and we will kind of cover this in the summary of this episode. Before that, I want to take your attention towards the biggest gainer of the year as a sector that has been majorly the energy sector, which includes oil and different types of energy sources, while the biggest loser of the year in terms of sectors has been technology. And I would like to point out that it was exactly the reverse this time last year. So the outlook was exactly the reverse, where a lot of it, especially November last year, I remember that it was all about renewable energy. It was all about, no one was even talking about energy actively at the time, and everything was about technology, Tesla, Amazon, Uber, growth funds. The fact to remember is that as nice as it is for growth companies to grow and become part of our daily lives, a lot of them are based on their potential profits and not their actual profits, which means that from this year it's become even more imperative to know the actual value of what you're investing in, number one, and to have diversification really on point. So even if you don't know fully about, let's say, different sectors, different ways of investing, then it's highlighted the need to equip yourself with that knowledge. Do a little bit of research. We live in a wonderful age where a lot of information is easily available, and not be exposed to just one sector, which could have, for example, even for me personally, I have a large exposure to growth. And that has been my learning in 2022 to diversify even more than I have previously.
Yeah, so this year really shows you the importance of diversification. While we said that stocks and bonds have been positively correlated and they've all lost money, what we see is within the equities market, for example, what's driven the losses and gains. Like Kalyani said, tech has been the key driver of negative performance while energy has done well. If you look at something called styles and factors within investments, growth is what she mentioned has really sold off. Something that's really done poorly is what's considered quality stocks. The reason for that is because quality stocks have had a high price and they've been expensive because they're considered to be good quality stocks, and they've sold off the most this year, which means you've done the worst on so-called quality stocks. The reason for that is because they're more expensive, and they do have a strong link to interest rates, where the value is, a lot more of the value is derived from the future projections or expectations from a particular company. And so for that reason, it's important to understand the underlying theme that a company kind of follows in terms of its style and how it behaves. These factors, you cannot time it, like you can't time sectors, you cannot time countries. This is why diversification is that much more important. Like, for example, in the countries, the most unexpected countries have outperformed and underperformed, where the largest outperformer, which is the country that's done the best based on the data I have in front of me as of the 15th of December is Turkey, which is up 103% this year. I mean, who would have thought, right?
Crazy, honestly. You hear about Turkey more as a refugee destination, as giving, aid to countries around them, but not in terms of markets, and that's nice to see.
Yeah, exactly. And then the country or the region that's done the worst is, as you would expect, the Russia-Ukraine crisis has impacted Eastern Europe. And so that's the region that's done the worst at negative 82%, which is quite a big chunk. I mean, Russia stopped trading. A lot of people have marked down their values on their Russian investments to zero. And so that has driven a lot of the Eastern Europe performance.
Yes, I would like to ask you, Rupali. Actually, I would like to first mention the two words that I don't want to hear in 2023 are probably inflation and interest rates. I think we've heard a lot of it this year. Do you have any words that you'd leave behind in 2022?
Yes.
Go on.
Those two for sure. But I think recession. And the second one is historic.
Yes. And some two words that I would like to hear in 2023 more of would be stability and confidence.
Yeah, I think the two for me are the first one I think of immediately is consistency, and the second one is just growth, not growth in the sense of the style that we just mentioned, but just growth in life, growth in your knowledge in investments, growth in performance, things like that.
Yeah. I think there are three themes for this year that I would like to highlight. The first one is the Russia-Ukraine war that kind of came upon the world, and it's something that a lot of us haven't seen playing out in our lifetimes. The second one is the continuing after effects of COVID, whether it is response from the government's cash pumping in 2020, 2021, or the continuing China lockdowns, which has been in the highlights, in the limelight a lot, especially because that leads to increase of cost of raw materials, same as the Russia-Ukraine war. And lastly, as a result of these two, the buzz phrases that have been mentioned previously as inflation and interest rate hike. So this is kind of like, this summarizes a lot of the news that we've seen going in 2022. With that, let's leave our listeners with a bit of a forward recommendation. How do you see 2023? If people are looking at financials, people are looking at markets, then what should they be considering?
I think a big theme that's coming out is, as we've seen, interest rates have been a driver this year. So something that's coming up in markets a lot more now is that while the Fed may stop increasing interest rates in Q1, they're probably not going to reduce interest rates until 2024 likely. And so we need to get used to the higher interest rates. I think what will help markets is the fact that it will hopefully be a little more predictable than it has been this year. So the perceived risk may be slightly lower, which always helps in terms of stability, in terms of, projections, in terms of all sorts of stuff. So that's kind of what I'm thinking of when I'm looking at the year. There are the factors such as the Russia-Ukraine crisis that you cannot kind of predict or, but that's, yeah.
Yeah, and I think for context also, this has happened after about a 10-year period of having good, healthy growth in the markets. So this was something that was necessary and healthy, as I like to repeat, especially as a result of what the Fed did with pumping cash in the economy. So the worst that you could do is add to the panic, play into the panic that's already there, already present around us. And if you're able to kind of move away from the herd mentality and be a contrarian thinker, kind of think differently, that's how people make money, that's how people become rich. And we are always here to kind of share our knowledge in aiding this process. You can reach us with DMs on our Instagram handle at Fantastic Females, and we would love to incorporate more of that in the next year.
I think I'd just like to end this discussion, Kalyani, on a little bit more upbeat note in terms of how I'm thinking of the year ahead, in terms of myself, things that are in my control versus things that are not in my control. And so a big theme for me, as I mentioned previously, is to really upskill myself further, to, be prepared for whatever it is that comes next in the best way possible. And so learning is a big part of it. Kalyani's got this exciting course that's coming up, that has come up actually. Wow.
Yeah.
And so that's a great place to start in terms of investments, in terms of thinking about a 3 to 5 year plan, in terms of, your money situation, your job situation, your personal growth, I personally am putting into place a plan for 3 to 5 years. What do I need to start today to be at a certain place in 3 years' time? And so that's how I'm taking it. While markets have been negative, it's an opportunity, like I said. Upskill yourself and kind of just invest. There's never a right time or a wrong time.
Yeah, and I'm also kind of looking back at 2022 with a positive outlook to what all we did achieve. So personally, I've launched Trading Mum and built regularity with content creation, which itself was a big one for me. We've launched Fantastic Females out of the blue, and it's been a fantastic journey. We've had 17 episodes being regular every single week, and kind of unpacking a lot of what we see around us in the world of finance, especially the markets. So these are some wins that I'm taking forward for the year. And even in terms of the markets, I feel like last 2 years, 2020 and 2021, were very much crowded by day traders with that mentality of pump and dump, to the moon. You heard a lot of these phrases, and people were just jumping on the bandwagon, whereas there were lesser serious investors that were coming to the limelight. And I hope that this shake-up means that we see a lot more of the serious investors taking more space in the media, imparting the right knowledge to the right people. And I think it feels like it was a necessary kind of shake-off for the market as well. So I'm pretty bullish for 2023. In one way or the other, I think it's going to be a fantastic year.
Absolutely.
Just to let you know, the next 2 weeks, for the last week of December and the first week of January, there will be no podcast episodes, and we'll be consolidating our mind space into bringing the best content to you in 2023. Have a lovely Christmas and a happy new year to all of you.
So with that, we bring this episode of our financial adventure to an end. Please follow us on all social media platforms at Fantastic Females.
None of the information provided is financial advice, and Fantastic Females is not a financial advisor.
The information provided is educational only. It is general in nature and does not take into account your personal circumstances.
Please use your own due diligence before making any financial or investment decisions.